$1,000 in Tesla stock turns into $360,000. The catch? You had to buy it 16 years ago. That's not the kind of return that changes a portfolio. It changes a family. And it already happened. It's done. So the only question that actually matters is this. Can Tesla do it again from today's price? Or did you have to be there at the start? I ran Tesla through the framework that caught every 100 bagger across 50 years of market history. 6 conditions. 5 of them still hold. The one that fails is the one almost nobody talks about, and it quietly answers the whole question. Stick with me, because by the end, you'll know exactly what you'd be betting on if you bought Tesla today. Chris Mayer studied every stock that turned $1 into $100 between 1962 and 2014. 365 companies, and almost all of them shared the same 6 traits. But before we score Tesla against them, one decision changes everything. If you judge Tesla as a car company, the numbers look rough. Stalled revenue, shrinking margins, BYD eating its lunch. If you judge it as an AI company that happens to sell cars to fund itself, you're looking at a completely different business. So I'm going to show you both. Watch which one the framework actually rewards. Start with the bad news. As a car company, Tesla has stalled. Revenue didn't just slow down, it shrank from $97.7 billion in 2024 to $94.8 billion in 2025. Tesla cut prices to protect sales, and it still wasn't enough. In 2025, BYD outsold Tesla in pure electric vehicles worldwide for the first full year ever. On cars alone, not a growth company anymore. But here's what the market keeps missing. There's a business hiding inside Tesla that's growing fast. Energy storage, the big utility-scale megapacks, and the home power walls. That division pulled in $12.8 billion in 2025. Installations jumped almost 50% in a single year. And, this is the part that matters, it now earns higher margins than selling cars does. And then there's the business that barely shows up in the numbers yet. This is where it gets interesting. The robo-taxi market is projected to explode from a few $100 million not long ago to tens of billions by 2030, with the most bullish forecasts reaching $100 billion. Right now, Waymo is ahead. Millions of driverless trips, real paid rides across about 10 cities. Tesla's just getting started. A handful of cars with nobody in the driver's seat across 3 Texas cities, and Musk himself admits robo-taxi revenue won't be meaningful this year. So, why does anyone think Tesla can catch up? Hold that question. The answer is condition 3, and it's the heart of this whole thing. For now, the Cybercab, a purpose-built robo-taxi with no steering wheel, rolled off the line in early 2026. Optimus, the humanoid robot, is aiming to start production by summer. Neither makes real money yet. So, high growth? Not from cars. That growth wave has crested. But energy is compounding, and the AI bets are real, just early. Tesla's already catching the next wave. It meets condition 1, just not as a car maker. Here's a number that should worry you. Back in 2022, for every dollar Tesla put to work, it earned almost 30 cents back. By 2025, that dropped to somewhere between 5 and 8 cents. That's a steep fall. But Mayer says don't panic at the number. Ask why it fell. 2 possible reasons. 1, the business is losing its edge, and competitors are grinding its profits away. 2, management is pouring money into new businesses that cost a lot now and pay off later. So, look at where Tesla's money is actually going. New gigafactories, a $16.5 billion deal with Samsung to build custom AI chips, $2 billion into xAI, Musk's AI company. Entire production lines at its Fremont factory ripped out and rebuilt to make robots. And one move tells you how the company thinks. In 2025, Tesla killed Dojo, its own supercomputer project, the moment a better path showed up, and swallowed the money already spent without flinching. This is the Amazon playbook. Starve profits on purpose to build something bigger. The capital is clearly going somewhere. We just can't prove it's working yet. So, high returns? Not right now, they've fallen hard. But that's the price of preparing for the next wave of growth. Tesla meets condition 2. The reinvestment is real. Those high returns just haven't shown up yet. Remember the question from earlier? Why does anyone think Tesla catches Waymo? Here's the answer. A moat is just the thing that keeps competitors out. And as a car company, Tesla's moat is leaking. BYD has passed Tesla on volume worldwide and builds comparable cars for less across China, Southeast Asia, and Europe. But as an AI company, different story entirely. Waymo, the leader, drives using LiDAR, spinning laser sensors, plus a detailed pre-built map of every city it enters. It works, but every new city needs a whole new map. That's slow and it's expensive. Tesla went the other way. No LiDAR, no maps, just 8 cameras and a single neural network that learned to drive the way you did, by watching, not by memorizing a map. No map dependency means it can run on roads nobody pre-surveyed for it, and it gets cheaper as it scales. Morgan Stanley pegs Tesla's robo-taxi cost at about 81 cents a mile versus Waymo's $1.36 and up. If Tesla closes the safety gap, it walks in at a price Waymo can't match. Why can it do this? Data. Tesla's cars have driven over 10 billion real-world miles on full self-driving, and they add roughly 1 billion more every month. Nobody else is close. More miles make the AI smarter, and a smarter AI sells more cars that collect more miles. It feeds itself. Then there's a second moat you can't put on a balance sheet, the people and the culture that picks them. Think about Musk's track record. The world's most valuable car maker, the first private company to put astronauts in orbit, now humanoid robots. Whatever you think of him, that record pulls in engineers who want to work on impossible problems next to a team that has actually shipped a few. And Tesla runs hot on purpose. Brutal deadlines, high burnout. The people who stay are the ones who find that thrilling instead of crushing. Musk will even blow up his own winning products. He tore out the Model S and X lines to build Optimus, not because those cars failed, but because the next thing mattered more. A hired CEO protects what works. A founder bets it on what's next. BYD can copy the cars and poach the engineers. That culture is a lot harder to steal. This time, Tesla meets condition 3 cleanly. The moat is confirmed in data, in culture, in self-disruption. Mayer's 4th trait: you want a founder with skin in the game.
Tesla has one. Musk co-founded the company, still runs it, and owns about 13% outright, north of 20% once you count his options. Over $200 billion of his own net worth is riding on it. When that much of your money is on the line, you think like a long-term shareholder because you are one. The catch is focus. Musk is also running SpaceX, which just absorbed his AI company, and he's juggling more than any one person arguably should. So Tesla meets condition 4. The ownership is rock solid. And now we get to the one that fails. This is the condition from the hook, the one nobody talks about. So stay with me because it reframes everything. Mayer found something simple about his 100 baggers. They started small. The typical one was worth around $500 million at the start of its run. Small companies have room to multiply. Giant ones don't. Tesla today is worth somewhere between $1.4 and $1.6 trillion. So do the math on 100x from here. Tesla would have to reach $140 to $160 trillion. Now here's the number that should stop you cold.
every public company on the entire planet combined is worth about $135 to $155 trillion today. A 100x from here means Tesla alone would be worth just about as much as every listed company on Earth put together. That's not a knock on Tesla, it's just how big it already is. Never say never, but from here, a 100x is the longest of long shots. And notice, that 360 bagger from the intro, that was real. From 2010 to 2021, the people who spotted Tesla early and white-knuckled the whole ride made life-changing money. The framework worked perfectly. The problem isn't that the framework is wrong about Tesla, it's that Tesla already graduated. So condition 5 is the one Tesla has outgrown. But here's the twist. Failing it doesn't mean Tesla is a bad buy. It means we've been asking the wrong question. One condition left, and it's the hardest one to actually live. Tesla is brutal to hold. Brand sentiment has soured. Sales slid in Germany. Full self-driving blew past its end of 2025 deadline. Optimus has been promised and re-promised with no real revenue behind it. But Mayer's idea of patience isn't just gritting your teeth while the price falls. It's understanding what you own well enough to tell the difference between noise and a real crack in the story. Every one of those headlines is either temporary friction on a decade-long build or an early warning. And right now, you genuinely can't tell which.
Condition 6 is the one that's on you, not Tesla. This stock can reward patience, but it'll demand plenty of it. So step out of the checklist for a second. If 100x from here is a long shot, and it really is, then what's the right question? It's this. Can Tesla build a second act big enough to matter to someone buying today? Break it into 3 pieces. The car business stalled. BYD is underpricing Tesla. Margins are squeezed, and the cars alone don't justify the price tag. Energy storage, a genuine growth engine the market still ignores because it keeps filing Tesla under car maker. Revenue up, installations up nearly 50%, margins now beating the cars. And then the 2 long shots. Self-driving, a market that could reach tens of billions by 2030, where Tesla is behind on the road but ahead on cost and data. And humanoid robots, where nobody has proven anything yet, but if it works, that one business could eventually be worth more than all of Tesla today. Here's the honest version. Tesla's price right now is basically a bet on whether autonomy and robotics actually come together. If they do, the upside is real. If they don't, the car business can't hold up the valuation. The framework can't make that call for you. It can only show you clearly what you're betting on. So here's where I land. $1,000 at Tesla's IPO became roughly $360,000 at the 2021 peak. That wasn't a trade, it was a decade of conviction, while almost everyone else either missed it or bailed early. 100 bagger from here? The real question is whether Tesla can build a second act big enough to reward the people buying now, and whether today's price has already baked in too much of that hope. 5 of 6 conditions hold, most with an asterisk. Energy is compounding, the moat in data and culture is real, the founder is all in, even if he's spread thin. Returns are down, but the money is flowing into the next wave of growth. And the one condition that fails, that Tesla is now too big for an easy 100x, doesn't tell you it's a bad investment. It tells you the original question retired. What's left is harder to name. A giant platform with a real shot at a second act, if the tech comes together, if regulators allow it, and if management pulls off businesses nobody has proven yet. Here's the scorecard. High growth, confirmed, with strings. Energy up, cars down, AI early. Reinvestment, confirmed, with strings. Returns down, capital flowing into what's next. Competitive moat, confirmed, in data, culture, and self-disruption.
Owner-operator, confirmed. Skin in the game, attention divided. Small enough to grow, fails. 100x is a long shot now, but whether it still compounds is the real question. Patience, the demand's on you. Required, heavily. Buy right, hold on, and know exactly what you bought. One last thing. The content in this video is for reference only and does not constitute investment advice. All investments carry risk. Please make your own judgment based on your personal circumstances.